Okay. Hello, everybody. Welcome. I'm Sandeep Matai. Some of you know me from the group, and tonight we're going to just go over the basics of options, and then also some talk on technical analysis. So I will start with just today. We'll keep it very basic, and then we'll build on from this in the future. Basically, options are something that, as you know, I trade a lot, and I enjoy trading because you can many times be wrong and still get a second chance. For example, in stocks, if you buy it, you're in it, and there's not anything else you can do except hope that it goes up or down if you're short. But with an option, you have many ways to play with it, and then if you learn how to use options along with stocks, you can actually benefit because you can hedge, you can sell calls against your stock, you can do a lot of things to get more from your stock. So we're going to kind of go over those topics, but tonight we're going to just talk about buying options simply, not getting into selling options yet. So an option is basically something you can buy. It's an asset, like a stock is an asset. An option is an asset. The only difference is an option is called a depreciating asset because it has a time factor involved. So basically, if you buy an option, it has a time value and it declines every day over time. And then we're going to talk about the option chain and all that. So basically, there are two main options. There's a call and there's a put. If you are bullish, you will buy a call. And here, the call options are contracts that give you the right but not the obligation to buy a stock or any underlying. So a call is something you buy when you want to be long something or want to be playing something upward. You would buy a call, and basically it's like almost like a lease. You lease to own. Anytime you want to own it, you can exercise that call if you want, or you can just play with that lease or that call, and that every day, every moment, that call has value based on what the underlying is doing, as well as time and volatility, other factors. So a call is something you buy when you're bullish. And on the other side, put is a contract giving you the right but not the obligation to sell a specified amount of a security. So a put is something you basically buy if you are bearish or if you want to play it downwards. If you think something is going to go down, you basically buy a put. And then also puts, people buy them as insurance. If you own stock, you can buy a put like an insurance policy that will protect you if it drops below that price level. So puts are great for insurance as well as playing something to the downside. And on the other side was the call. Okay. I don't know if there are any questions. I don't know if other people are able to chime in, but if not, it's okay. Okay. So again, just remembering call up and put down. It's just easy to remember. When you call somebody up, you call up, or if you put somebody down, you put them down. Call up, put down. That's the best way to remember what's what. So that's the basic of what a call and a put is. And then the benefits of options are that they have limited capital requirement. When you buy an option, you pay a certain amount, but you don't have to buy or pay for the full amount of a stock. For example, if Amazon is $1,000, you buy 100 shares, that's $100,000. But you can buy an option for, let's say, $2,000. So you have less requirements, which is the biggest benefit of an option. Of course, the downside is it has time value. And the other benefit is that it has limited risk. You can only lose what you pay in premium. And premium meaning the price that you purchase it for. So if you pay $200 for a call, that's all that you can lose. So again, we're talking about buying today, buying options. So if you are buying an option, the most you can lose is the amount that you pay for that option. So those are the two biggest benefits of options. Then we're going to look at reading the option chain next. And if there's any questions, feel free to let me know. Okay.
So we're just going to look at anything Apple. Okay. So we're going to look at Apple. Let's look at the chart. Okay, this is Apple. Closed at roughly $230. So it's $230 a share to purchase Apple right now. So if you buy 100 shares, $23,000 is what you would pay for every 100 shares, or whatever shares you want. It's $230 a share. So if you buy 100 shares, $23,000, excuse me. Okay, let's look at an option chain. Now, this is an option chain, so depending on what platform you have, you will type in your stock, and then you will get an option chain, and then you will see all these months that basically are there where you can buy options. And then within each month is lots and lots of strikes. So this is where people get confused, because they're like, what do I do? What do I buy? So we are going to make it simple. So again, this is the option chain. And these are the months. Each month, or week even, in case of Apple has weeklies, basically is the day that it expires. So the option, this expires October 18th, October 25th, and then you can see that you can buy options all the way to 2020, and even 2021, and even 2022 on some stocks. So you could buy an option for 2022, and basically it doesn't expire until that date. So pricing, the less time you have, the cheaper they are. The further out in time you buy, the more expensive they are. So just an example, this is $230. We're just going to look at a 230 strike. And this is the strike, meaning where that option becomes worth something at 230. So if we buy this $230 option, you look over here to the left is the calls, and on the right are the puts. Again, the bullish bets are calls, the bearish bets are puts. And you look at the price, and then if you know what bid and ask is where you can buy or where you can sell, and you can look at the prices. The bid and ask for Apple is 330 by 365. And what I do is I set up a column called mark, and that's just a midpoint of the bid and ask. That's kind of what I look at, just to give me an idea of what the cost is, or where I want to bid for it, or anything like that. So just like you can make an offer for a stock, you can do the same thing for an option. Let's say Apple is $230. I want to buy it at $225. I can put an order in, limit order for $225, and it's going to fill when it goes to that level. Same thing here. If I wanted to bid on this, it's $350 roughly. So it's basically 3.50 roughly. That's for one share in theory. Options are sold in blocks of 100 shares, or 100 blocks. One option contract is 100 shares, or controls 100 shares. So you can just, this is $350 a share. So 100 shares will be $350. So this again, like I said, you buy them in 100 lots. So $350 is what it costs to buy one Apple option that expires October 18th at 230 strike. So this is where you see the prices, bid and ask. You can set up a mark column, or you can kind of guess the middle. And these are the prices here that we look at. On the put side is the opposite. 230. A put is about where's my mark? Right here. It's $335 roughly. So that's how you look at the prices. Again, these are the strikes. These are where you have an option of buying far out or way. I'm going to explain what in the money and all that is, but basically these are all the different strikes that are available. So again, this $230 strike option is $350 for October. And just to compare, if we wanted to buy that same options for, let's say, September 2021, that option will cost you $3,500 roughly. So if you want to make a bullish bet for 2021 at a 230 strike, you would pay $3,500 to control 100 shares of Apple for the whole duration. So again, this option gives you the control over that stock, that you have the control over it, that you have a lease to own, so to speak. So again, as further out you go, the more expensive they are. The less in time, the less expensive they are. So again, these are the strikes, and then these are all the different expirations. Basically, that's how you look at an option chain. Now let's talk about sometimes you'll hear in the money, at the money, or out of the money. Okay, so the strike is $230 for Apple. Right now it's $230 roughly. So that strike at $230 is called at the money. That's at the money. That means that right now it's at the money. It's worth something. So it's called at the money. And then when you go deeper in, these are called in the money. That means they already have value. I could buy a 210 and I'm going to pay about $1,970 for it. And it already has $20 of profit, so to speak, in it. That's 210 to 230. So the more you go in, those are called in the money. At the strike is called at the money. And then when you go further out, these are called out of the money. So for example, if I wanted to bet that Apple's going to go to 250, I could buy this for $3 roughly. And basically I would own the option. It's only worth something if it goes over 250. So it's, some people make bets like that, is they just buy, an option higher out of the money because it's cheaper, and they just make a bullish bet. I'm not sure what that noise is. Okay. All right.
I just muted that, so you should be good.
Okay, thank you. Okay, perfect. All right, cool. So again, these are in the money, at the money, and out of the money. So the further out you go, they're out of the money. And so that's how you look at the prices. That's what, when you hear at the money, in the money, or out of the money, that's what they're talking about. And again, these are the different months. Here tells you how many days till expiration. We have 1 day for this one. We have 71 days for this one. So this tells you how many days. And then we'll talk about it later, but over here, these numbers are called volatility, the implied volatility. This just tells you the expected move in each expiration. So right now, for next week, it's about an 8-point expected move up or down. And then when you get to earnings weeks, whenever that is, you'll notice that it'll have a higher number there. What has earnings next week? Netflix. So Netflix, for example, these are the strikes. You will notice that the implied volatility for next week is higher than even the months after it or weeks after it, because it has earnings that day. So these are the implied volatility. That's the expected move, a 30-point expected move at this point for next week. So this is what these numbers are: implied volatility, expected moves based on options. So again, like Netflix is $280. If I wanted to, the options for next week will be expensive. So the higher this volatility is, the more expensive they are, because whoever's selling those options wants to be paid for their risk. So for example, a 280 at the money strike is about $1,530 for next week. If I wanted to go deep in the money, I would pay more. If I wanted to if I think that Netflix is going to pop to 300, I could buy a 300 strike one, pay $770. I own it over 300, and then I have to keep in mind that I'm paying this premium. So if I buy the 300, I need to go over 300 plus the 770 to make money. So I needed to go over $307 roughly to profit on this trade. So you want to keep in mind that that premium you're paying is taken away from your potential profit, but that's the price you're paying. Or you could buy the stock at $28,000 for 100 shares. So $28,000, or I could pay $1,500. The drawback here is it has a time limit. The benefit here is that it's less capital. If this thing collapses, if it goes from 280 to 200, I'll lose a lot of money on the stock, but on the option I would lose the 1500 premium as a max loss. So that's the benefit on making bets with options, is that you have a limited risk, and that's the most you can lose. So again, when you have earnings, they will be more expensive because of the volatility being higher. So that's what these numbers here are. And then we are going to talk about okay, so let's see what we got here. So we'll now talk about, sometimes you'll hear about Greeks. Let me see if I can get that.
Sandeep, I don't know if you are keeping an eye on a question has popped up. I don't know if you.
Oh, yeah, please. And I gotta figure out where to look for those. Okay, sorry. Okay, thank you. Okay. Let's see. I see. You say long on most of your options. How long? Okay. You say long on most of your options. How long do you go? Okay, that's a personal preference, but I personally don't like to go too far out. I usually will do the next full month. For example, if I were to buy a Netflix, let's say Netflix, fine. If I were to say Netflix, I won't do, like, if I'm making a bullish bet, I'm buying the call, I won't do next week, the next month, if it only has so let me tell you this. These white ones are the monthly expirations, and these yellow ones are the weekly. So I look at the monthly expirations, and some things have weeklies, and some things don't. Some things have just monthlies. Like some of the stocks, like let's just say Shopify, they have weeklies too. But some stocks you'll see that only have monthly. So anyway, these are the monthly. So usually I will go for the next full month, is what I kind of go for, because if you go too short in, it's burning time. And let's see. Okay. So anyway, I go for the next full month or 2 months out maybe. I don't go for the leaps. Now I know people do the ones far out are called leaps. I don't do those because I'm like, that's a lot of premium to pay and just wait. But people do it, and nothing wrong with that. I usually prefer the next full month or the month after. And then later on, in the next session, we'll talk about spreads, where you do it and you sell a call above it to help reduce your cash outlay. But we'll talk about that next time. But for now, I would just say the next full month, usually at least 30 to 50 days is kind of what you want to go for. If you go too little, they're going to decay pretty fast, unless you're making a bet on some kind of event or anything, anything happening, then you could do shorter. But again, like I said, I usually do about 2 months average, kind of is what I go for. Okay, alrighty. So now let's talk about the Greeks. Sometimes you'll hear me talk about theta a lot, but the options are they're called the Greeks, and I'm trying to figure out how to make this. Stop doing this. If I just have this here. Okay. So the Greeks. Okay. There are 4 main Greeks. Delta. There's another one, but we don't really worry about it. But main Greeks are delta, gamma, theta, and vega. So the delta measures the degree to which an option is exposed to shifts in the price of an asset. So if you buy a stock, it has a delta of 1. If you buy a stock, if it goes up 1, you make $1, or down 1, you lose $1. So it has a delta of 1. So delta. When we go back to the option chain, you want to set up set it up where you can see, and most time they're there, but if not, there's a delta, theta, gamma, and options, open interest, sorry, but these are the main ones. Vega is there, but I don't know why I don't have it on this, but let's see if I have. Let's do this. Okay. So delta is on this column here. So now let's look at Apple. Okay, again, that was $230 right now. So there's a delta. Now you'll notice that like this is 230 right here. So usually at the money has roughly about a 0.5 delta. It's about 50 cents or 0.5 delta. The deeper you go in, the greater the delta will be closer to 1. So, and the further you go out, the less the delta will be. So again, like I said, if you buy a stock of Apple, $230 a share, if it goes up 1, you get $1. If it goes down 1, you lose $1. So that has a delta of 1. So if you want to kind of mimic stock, some people do that is they want to have 100 shares of stock, so they'll come and find some delta close to 1, and that's what they'll buy. Because they're like, I want 1-to-1 movement, and so they'll come here, they'll buy, for example, in this case, this 222 strike, which is going to give you a delta of 1. So if it goes up $1, you make $1, and same thing for the downside. So this is the delta. Again, that's how sensitive it is. Each dollar that it goes up, how much are you making? So if you buy at the money, it's about 57. Let's just assume it was around 50 cents, 0.5. If it went up, you would make 50 cents a share or $50 for the 100 lot. So $50 if it goes up, $50 if it goes down. If you buy this one, you make 100 if it goes up, 100 if it goes down. So this just tells you like how sensitive is the movement. So of course, the more the more delta, the more you got to pay. The less the delta, the less you got to pay. If I wanted to just make a bet for Apple that's going to go to 235, I could buy this 30 delta and pay about $135. It's less money, but less movement as it goes up. So delta is, again, how sensitive it is to the price of the underlying. How much movement do you get 1-to-1? Okay, gamma is the rate of change of the delta. So it's kind of like the delta of the delta. So gamma, we look at it, but we don't focus too much on it. So the gamma is here. So let's look at this 230 strike. So the gamma is in this column. So right now the delta is 57. If it moves up $1, this tells you how much is going to add to this delta. So this tells you if it moves up $1, your delta is going to roughly change to 57 plus 6, which will be 63. And then if it moves up another, it'll be another 6. So this just tells you how much, as it moves in your direction, how much does your delta change. This tells you that. So this is the change of your delta that will happen as it goes up or down. So that's the gamma. And when you buy options and when it gets close to expiration, your gamma is pretty high because they're very sensitive to movement. So the gamma increases generally as you get closer to expiration. And that's when it comes into play more. You might hear gamma risk and all these things. That comes into play at usually expiration. But that's just something to know what gamma is. So delta, gamma. Now, theta I'm going to come back to. Vega is how much it changes in the volatility. How much does volatility affect your option? That's an important one because you will hear about volatility, and many people may not know what it is. But volatility is just how much fear there's in the market. You'll always hear the VIX and all these things. This is a VXX chart here. So when volatility goes high, options get expensive. When volatility goes low, options get cheaper. Volatility is factored into the price of options. So when volatility really rises, you pay a lot for options, especially for the put side, the downside protection, or playing it downwards. Puts get very expensive when volatility is high, and they get cheaper when volatility is low. Calls get expensive when volatility is high, but not as expensive as puts. There's a little difference. They do get more expensive, but the effect on puts is much more, and when we take advantage of that. So, and we'll discuss that later on. So again, this is volatility, and going back to the chart, there's a Vega column, And this tells you how sensitive it is to Vega. It's 14. So roughly, if volatility increases by $1, this is 230 again, at the money, the volatility increases, this is going to go up by $14 or down or up. So if volatility increases a percent, this is going to go up $14 or 14 cents a share, meaning 1,400. So that is the Vega, volatility sensitivity. Okay, and then my all-time favorite is Theta. Theta is the rate at which options lose their value, specifically time value, as the expiration date draws nearer. This is a negative number. Okay, so it decreases every day. So Theta is good and bad. Okay, so Theta is bad for options buyers. So Theta is how much your option is burning every day. So now again, an option is a depreciating asset. It has a limited time before it expires. You choose how long you want that to be by the month that you buy. But the closer in to time, the more they decay, the greater the Theta. So again, the Theta column is here. So let's look at 230. So 230, this option for Apple at the money that's expiring on October 18th, next 8 days, is burning $15 a day. So every day is, at this moment in time, it's burning $15. And this number will increase as you get closer to expiration. This might become 16, 17, 20. It'll increase the greater it gets to expiration. So look at that. That's 15. Now let's look at January 2021. Okay, January 2020, 230 strike. Boom, 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 right here. Theta. It's burning $3 a day, so a lot less the further out. Okay, so the further out you go, the less they're burning. So people buy these far out ones, and there's nothing wrong with that because they don't burn as much. They're just kind of sitting there. And as the stock goes up, these go up as well. So you can make money on this as well. It just takes more capital. But nothing wrong with buying leaps or far out options, if you prefer to do that. So again, the Theta is how much is burning every day. This is the number. So just a side note is, I always talk about Theta burn and Theta. So on the flip side, when we get to the next level of selling options, and again, disclaimer, you don't want to go out selling options until you understand what you're doing. We're talking about buying options, and nothing wrong with that as well, to make speculative bets, to hedge. It's great. But when we talk about selling later, this is the number I'm interested in, because when I sell, so whoever is buying an option, somebody is selling it to you. So if somebody sold you the option, this is what they're making every day by selling you this option. You're losing this, they're making this. So they're taking the risk. They're taking unlimited risk while you have limited risk. So that's your benefit. You have limited risk. So again, not to get away too much, Theta is, you'll hear me a lot. I just want you to know what it is. It's the time decay. And what I do is I combine a lot of positions of selling options to create this great Theta number, and while trying to stay neutral on Delta. But that's another issue. I'm not going to get too much in that. But just wanted you to know what Theta is. It's the time decay every day. So Delta we know, Gamma now we know, Theta and Vega. So now you know all the elements of the option chain. You know the strikes. Just making sure if there's any questions on that. Pricing, strikes, what strike to choose, people ask sometimes. Again, depends on how bullish or bearish you are. So let's just look at something that's been falling, or if we're bearish on something. What is in a downtrend lately? Anybody think of anything? Like I know Roku was last week. What has been in a downtrend? Probably. Let me see. My mind is blank right now. Sorry. Well, anyway, we can just kind of look at it with Netflix. Netflix has high
volatility because, okay, thank you, CLF. Let's look at CLF. Okay, it's been kind of down. Okay, so it's a cheaper stock, so it won't show a lot of premium and stuff. But anyway, if you look at the 7-strike call, okay, let's look for November. Yeah, this one doesn't show. I was hoping that I want to find something that shows a lot of premium for the put side versus the call. Reason, let's see. Yeah, this is an example. Okay, so roughly, let's look at the chart. Yeah, it's kind of improved, but okay, sure. So anyway, I just wanted you to see that if when things are down, their volatility is high. So for example, this November, if I buy a 45 call, it might be $245, but the put is about $415. So the puts are generally more expensive when something is falling, and then they'll be less expensive when it's stable or going up. So again, puts tend to be more expensive, especially when things are falling, and they'll be cheap if the thing is just shooting up in the air. If something is really bullish, the puts will get cheaper, the calls will get more expensive. So it just depends, So that is a overview of reading. I just want to make sure everybody understands how to read an options chain, all the Greeks. And again, you should go back and kind of learn these if you don't understand, because you need to understand this. The strikes are there's all these different strikes. Don't get confused by all the strikes. Just remember, if you just want to buy something, and generally people ask me like, what do you buy? And nothing wrong with buying options. Some people feel like if you're an options trader that you should not be buying options, you should only be selling them. I disagree. I do well buying options if I'm bullish, because that's the whole or bearish, because that's the whole benefit of an option, is that you get to buy something that has limited risk, and you get unlimited upside or down, upside if you're either way. So that's the beauty of it. So if you're bullish or bearish, you can make a lot of money on options by buying them, but you got to buy them right and at the right time, and not gamble. But people blow up their money because they start gambling with options, and they're just making bets, and they start losing money, and they bet on earnings and all these things. And that's why you hear so many sad stories about people blowing their accounts with options. So caution is advised. But people are always so fearful of options. But it's actually one of the greatest things. Maybe I'm biased, but because you have limited risk and unlimited upside if you're buying them. And if you know what you're doing, of course, no one knows the future, but you have a lot of things in your favor, and you can also make adjustments and do a lot of things if you're wrong. So again, if you're buying on options, I tend to buy, like some people like, okay, you wanted to buy Apple. I usually would just buy at the money. That's kind of my thing. I don't like, again, nothing wrong with buying deep in the money or in the money, but I'm like, why should I pay this money for profit that's already happened? If the whole purpose of buying an option is to have limited risk, why should I increase my risk? Why should I, like if I wanted this 210, why should I risk $1,970? If this between 210 and 230 has already happened, I didn't profit from that. So why should I pay for that? Again, this is my thinking. So I tend to buy at the money or very close to it, because I'm like, that's my whole point. I want to risk less to make more. I don't want to risk all this money here. I want to risk less. But at the same time, some people buy out here. To me, that's okay, but it's kind of gambling. The odds of it going like way out here are very little. Of course, it can happen with a biotech, earnings or things like that. But generally speaking, these are not likely to happen. So I kind of stay at the money, or maybe slightly out of the money. I might go up out of strike one just to kind of be in the stock or underlying, but with less money. So again, my preference is kind of at the money or slightly out of the money maybe. But pretty much I just kind of keep it simple, and I just look at the money. I'm like, hey, that's what I want. Because this delta will increase if you're right, and become one at some point if you're right. If you're wrong, it won't. Again, my preference of what strike to buy, at the money. So any stock, Roku,
closed at 116. I might have, if I was long, I might buy the 115, 117 or something, 150, 117, something like that, just to be in it. So again, that's my preference of where to buy. Again, people vary. Some people buy out of the money, some people buy in the money. It's up to you. But just my experience has been that why pay for profit that's already happened, or why gamble and just throw money out there and hoping. Of course, you can be wrong any of those ways, but that's kind of what I do. Any more questions on just the basics of options, what they are, Greeks, reading the option chain, every option, not everything has an option, but many stocks have options. And you can buy options on the S&P. It's not just stocks. You can buy it on the indexes, commodities, gold, you name it. Like if you want to buy gold, the GLD ETF, you could buy options on that, which I do all the time. You can buy their leverage stuff. Again, the main benefits too, again, are limited risk. You can only lose what you pay, and not have unlimited risk. And also the cost is less. Cash outlay is less. You pay less upfront to participate. And you don't get a one-to-one move if your delta is 50, but you're in it. And you can buy two of it then if you want, and you get the one delta. You can do it that way, either way. Okay, so now, if there's no more questions on the basic options, I'm going to go into a little bit of technical analysis, so that way we can try to keep this at an hour and not go too far. Okay, wait, sorry. Let's see, make sure nothing else on pricing, right? Greeks, in the money, we talked about out of the money. Okay. All right, so moving on to technical analysis. So there are two types of analysis. There's fundamental analysis and there's technical analysis. Fundamental analysis is what you see people talking about. They look at a company, they look at the earnings, they look at the earnings per share, the growth, the revenue, and all that's great. I mean, it's good to look at companies that are strong, have good balance sheets, all those things. You can look at the fundamentals of any company, on Yahoo or anywhere, and you can see their balance sheets. So that whole process of studying a company or anything is called fundamental analysis. Earnings, revenues, growth, yada, 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 all that stuff, which is great. Then the other side of it is called technical analysis, and that's the art and science of looking at charts and trying to gauge direction or different things. So this whole science of looking at charts is called technical analysis, and that's what we do. We look at fundamental, like I look at companies, see how strong they are, and I do prefer to buy and own fundamentally strong companies like Apple's and some of these companies that I put, the tech leaders that I put out every week. Those are good, strong companies with good balance sheets and all that stuff, cash flow. Those are good. But then, fine, you have a great company, but where do you buy it? Just knowing that a company has good financials is great, but then sometimes this company has great financials, Apple, but look at it, boom, it goes down too. So where do you buy it? That's the beauty of technical analysis, or the science, is to figure out where to buy it or where to sell it. Of course, nothing is guaranteed. The premise is that the chart reflects buyers and sellers, and it reflects some fundamentals too. Obviously, if a company has good fundamentals, it should have good sentiment, and it will tend to go up and down and up. So when earnings are great, you'll get pops. You'll get drops, and different things that happen. The belief is that the chart reflects a lot of that fundamentals and sentiment and buyers and sellers and institutional buying. And then, so we look at the chart and we look at the volume too. The volume, what moves stocks is institutions. The small retail traders and traders are not moving stocks. It's institutions that move stocks because they have the big buys and the big sells. They move it. Of course, nowadays there's algorithms and HFT traders and all these things, but generally speaking, it's institutions that move or have tended to move stocks, is because they have billions of dollars they're putting it out. So what we try to do is gauge institutional support and buying. So we look at the charts, we look at the moving averages, which I'll discuss, and also we look at volumes. We want volumes to rise as the stock is going up, and if we notice that a stock is going up and volume is declining, sometimes that's concerning. Or if we see big drops on high volume, it's not a good thing. We're seeing big drops of volume. So we look at volume to see. I have here a volume chart at the bottom. This is the average, for the last 50 days of this right here, this line. So we look at the volume, and then we look at the chart. And then some people also look at these indicators down here. You might hear about RSI, MACD, on balance volume. There's so many, and people use them, stochastics, and that's great. I personally don't use a lot of them. I've used them in the past, but to me, I guess you just kind of get a sense of, from the chart, what it's doing. But of course, nothing wrong with these indicators. People use them all the time, and it's great. People look for oversold, undersold, RSI, all this stuff. So there's a whole, there's some good ones. I would say RSI, on balance volume. Some people use MACD. Those are all good and they're fine. Again, you just have to stick with what works for you, study what works for you, and just kind of play with it and just kind of get a system going and go with it. So again, those are the indicators that people put at the bottom. You'll see all kinds of funky stuff and stochastics and all these things. And they're great, nothing wrong with that, but I don't really, to be honest, I never look at any of this stuff. I look at the chart and I look at the volume and I look at patterns. And being an option trader, I look for areas where I think stock is not going, because as a seller of options, I'm probably 80% seller and 20% buyer of options. So I look for areas where I don't think the price is going to sell options, not to confuse the buyers of options. But I also buy options when I'm bullish or bearish. For example, Roku recently had a nice fall. Here was I had a great time buying puts, because I usually don't buy options, but then in this case, it was like, well, this thing was dropping like a rock. And I think I bought some options that were like $20, and they've ended up selling for $250 in just a matter of hours or something. It was crazy. Anyway, so we look at these charts to see breakdowns, breakups, so on. Now, let me tell you the basics of technical analysis. Okay. Let's remove drawings. Okay, so. What's not doing it? Let's see. Okay. Sorry, I tried to figure out why it's doing this. Take it to another window. What's happening here? Okay, chart. You guys can still hear me, right?
Yes, we
Okay.
can. Yeah, we can.
Okay, perfect. Thank you. I don't know what's going on here, but anyway, so the chart is right here. I'm just looking at CRM. Okay, so there are two things that are very basic to technical analysis, and that is what's called support and resistance. Okay, so they're just, if nothing else, just know that, okay, like if you're in a room, there's a ceiling and there's a floor. You can't break through the ceiling and you can't break through the floor generally. So that's what we look at here. There's a ceiling on top that usually is holding a stock down, and then there's a floor that is holding it up. So what we try to do is we try to add in lines basically that are ceilings and floors. The ceiling line on top where prices are being held against is called resistance. This is a resistance line. The floor is called support. The floor of your house is support. The ceiling is where if you throw something up, it's going to resist. So again, resistance and support. If you know nothing else about technical analysis, it's support and resistance. That's one of the most important things, and that's what we always, sometimes you'll hear somebody say, where's the resistance? Where's the support? You know, that's where we want to know. We want to buy things at support levels. And we want to sell things at resistance levels. So this is CRM, Salesforce.com. You can see it's had a nice support and a resistance level. And I don't know why this thing is freezing what I'm doing. I'm trying to figure out here without reloading it. Okay, well, I don't want to take time up. So anyway, so what we look for is we look for levels of resistance. And why is it there? What's happening here? So resistance is telling you where there are more sellers than buyers. Resistance is telling you where people are taking profits. And so that's what we look at resistance for, is where we also want to look to take profits or take some off. Now things can, just because something has resistance doesn't mean it can't break through. It could, and it does. But until it does, there's a level where it just keeps hitting its head against, and that is called resistance. And that's where a lot of sellers are selling, or there are short sellers there, people who play it down are sitting up here ready to short down, or there's a lot of, so people who are long a stock will have stop orders to get me out, or limit orders. When it gets here, get me out. So what's happening here is when it goes up to a certain level, there's lots of sell orders. All these people down here want to take their profits. So all those sell orders come in and bring it down, bring it down, bring it down. So there's a lot of selling up here. So do you want to be buying up here? No. You could, but it's all about probability. Your probability of success of buying at a resistance level is low. Okay, so that's why we look at resistance as where you don't really want to buy. You want to sell, potentially. You want to go short, potentially. But you definitely don't really want to buy unless there's a compelling reason. Something has happened, there's some news or something, and it breaks out, which we'll talk about later. And the next phase is, but anyway, resistance is where you don't want to be buying, you want to be selling. And we look at resistance levels also in options later for selling options. But resistance. Now support is where you have people that want to buy the stock. People have got a lot of limit orders here, and that's where it gets picked up. There's buyers, so a lot happens here. Or sometimes shorts who have been playing a short have got their buy orders to get them out. So they also have a target. They also put in their buy orders. Okay, I'm shorting here. Now, shorting stock is when you play it down. And if you don't know what shorting is, I can explain that later. So basically, if you play something downwards, it's called shorting. So people who are short have to buy back to cover. So there's a lot of shorts who cover here. There's buyers that come here. So whenever you have support levels, that's where you get the bounces. So that's where the buy area. So resistance or sell areas, support a buyer. So where do we want to buy an option? If you're buying an option on CRM, for example, do I want to buy an option up here? No, the odds are very low. Here I could consider buying puts to play it down, or I could do something else. But down here, do I want to be selling the stock? Not really. It could break through, but generally speaking, high probability trade is for a bounce. Even sometimes a small bounce. This is where you want to be looking to buy. This is where you want to be looking to sell. And then, and I don't know why I'm not able to like draw and stuff. But let me. Okay, let's see if I have something up here. So now these lines can also be. They don't always have to be horizontal. Remove drawing. Okay, good. All right, cool. And I'm going to show you how I get it if I can get access to this. Remove drawing. Perfect. So people ask me, how do you draw your lines? So again, I just wanted you to see that the drawings they're not always horizontal. They can be angular. They can be odd shapes. So it's a little bit of art to it, a little bit of science, a little art, and it just takes a little practice. But it's fun. It's something I enjoy. So how do you draw the lines? So what I do is I first go out to a weekly. So now on the chart you have a daily chart, weekly chart. So very basically, each day on a daily chart is represented by this candle. These are called candles. And that's another art in itself, is looking at these candles, which I'll discuss a little later, is candlesticks. They're so great. If you're still using bar charts, I don't know why, I would say use candle charts, because they tell you visually, if nothing else, the colors. You can see the candles are green on up days and red on down days. So this visually tells you down weeks in this example, because this is a weekly, up weeks, down weeks. So this each day or week is represented by a bar. Okay. So what I do is I zoom out to the weekly chart. Let's see. Drawing. Start from scratch. And we can do anything, any chart, but okay. So what I look for is I look at weekly support levels where a lot of weeks have hit. There's a week here, a week here. So this looks like a good support level. Boom, 1, 2, 3. So then I come in, I get my drawing tool, a horizontal line, and I draw myself a nice weekly support level. Boom, right there. Boom, 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 right there. Hit 3 points. That's good. And I will also look for on the top side. 1 week, 2 weeks, 3 weeks. That's good. The more weeks, the better. So this is a resistance. This is a support. And let me just make sure there's no questions on me. Okay, cool. Let's see. So again, support, resistance. Now I'm looking at a weekly chart. So when I draw in the weekly, if I come back to a daily, it's really nice because it puts it for me nicely. It shows it to me. I'm trying to blow it up, but anyway. Again, daily. Okay, so now I have a good support. That's a weekly support because it has more value. And sometimes you'll see things go through it, but generally speaking, this is called dangling stuff, some people call it. But anyway, so this is a support level that's pretty good. So now let's look right here. This is Netflix. What happened? This support again held. Like recently it dropped and everybody's like, oh, this thing's going to 220, 230, but guess what? It didn't. Today was a very strong day. Probably tomorrow it could go up a little more. So anyway, these are levels where you want to look to buy perhaps. You don't want to be selling, generally speaking, here, because there's potential that people picking up here. There's all these shorts who are covering. There is people who want to buy. They come in here. So again, this support has worked out so far pretty well. Okay. So again, I zoom out to the weekly chart. I find the bottom of the candles each week is represented and the top. And some people just do it from the daily, and that's fine. But I feel like so much better than a weekly chart than transpose it to the daily. And also, we do them on the and like I said, we also do
we also look at angle. So I'm drawing this as a channel. Okay, so you know what? I'm not going to do a channel. I'm just going to do a trend line first. Trend line. Okay, so I'm just kind of seeing where it's hit here. 1, 2, 3 here. Okay, so 3 weeks, that's there. So we go back to the daily. Boom, we got a nice. Okay, and what's happened today on Netflix? It broke through this resistance on volume, which is pretty good. Good bullish sign. Of course, you know, this thing can fall back just as well, but this is called a breakout, so to speak. When you hear breakout, it means it breaks through a resistance line or support line, or break down for support on volume. So anyway, this is a trend line, also a resistance line, because that's where it was resisting, came back, and now broke through it. Time will tell if it's a true break or not. And then you can redraw these as channels like this, and it will give you another one, and I kind of do the same thing. I'll look at like several points. I'm just throwing this out now, but anyway, you're trying to find bounce points here as well. And again, if you do it on the weekly, you know, you'll get it much better. So anyway, and you can start out, sometimes I'll just do a channel from the get-go. I'll get a channel, boom, right there, and I'll look for the bottom points, kind of right there. You know, it's a little subjective, you know. So again, you got yourself a channel sideways, and you can do it for any stock, anything. You know, they all have channels, and this is Amazon. You got a resistance, you got support. You get support within here, and then you get trend lines. We can draw in, and it's fun the more you do it. You know, I could find myself a nice trend line here. And I could redraw this channel, and basically that's what you're doing. You're basically trying to figure out support and resistance, support, and then here it broke down through it and it formed a new, and then you get a new one. You have to wait to figure that out. So anyway, but you see how these horizontal lines are so important, how they work so well. You know, they work really well. Nothing is guaranteed, but it's all probability. It's a game of probability. So support, resistance. So that's what the basic of it. Then you have trend line sideways. And the last thing I'm going to discuss, I know it's getting late, is moving averages. These lines right here, or these lines right here are called moving averages. They are the average of the last X number of days. For example, my red right here is a 20-day moving average. That means this is an average of the last 20 days of prices. And it's called moving because it moves with each day. It takes a 20 and drops off the one before it. It takes 20, drops off one before it every day. So it's moving with the prices. The current day will go in and the old day will go out. So 20 days. This is called a 50. This is the 100. This is 150, and there's also a 200. So you know, it's preference again. I use the one I use a lot is the 50. Because institutions seem to look and use that a lot for buys. So I look at the 50 moving average as value. And some people ask, do I use exponential or simple? I use simple, but again, it's preference. You know, I use simple because most people use simple. So anyway, but again, nothing wrong with using exponential. And another a note is if you see things stacking like this, 20 over the 50, over the 100, over the 150, that's a more bullish sign. You want to see that when you're long a stock. When you see inversions like it's starting to happen, or when a stock falls, you know, let's look at daily. You know, you'll start. Okay, so Roku, for example, was a 20 over the 50, over the 100, over the 150. That's a nice stacking. That's what you want to see if you're long. But then when you start flip-flopping and the 20 starts coming under the 50, that's kind of a bearish thing. You don't really, you don't really want to be like going long on that. So again, you want to see them stack nicely. And now the other thing is that these moving averages are not just moving averages. They're also support levels. Same thing like the lines that we had. These also become support levels. You will see price go up and then come down to a 50-day moving average, bounce, you know, bounce, but then bounce a little bit, then collapsed because of some news. So anyway, you'll see, a lot of strong stocks will, kind of bounce off their 50s, like Apple, for example. Bounce, can close. So the 50s tend to be good support levels, and then, then other ones can be here. So again, when they're upward, they should be stacked in the right order. When they're downward, they're usually stacked opposite. The 20s at the bottom, the 50, then the 100. That's a downtrend. And this 20 became resistance. Boom, resistance. So you will see these moving averages also become resistance and support. So you kind of use that combinations of support and resistance with moving averages and trend lines, okay? So that is the very basic of technical analysis. And if that's all you know, that's good enough. No support resistances and moving averages. Then next time we'll get into patterns like cup and handles and all these things, and a little more into other things. And if there's any particular questions you have, or any of the indicators at the bottom that you want to go over, or somebody else wants to go over, that's fine too. So again, that's the basic of technical analysis. We learned about options tonight, and that's the basics. And I'm going to let you go. If anything else, any questions? Okay, so just to update, futures are up. I'm watching the futures here, just so we know, with all this China stuff. So you'll see me during the day putting these up. This is the ES, which is the S&P futures, the NASDAQ futures, the small cap futures, and this is the Dow futures, okay? These are charts. These are my charts that are up all night. Right now, the Dow futures are up 68 points. The NASDAQ, the S&P futures are up 7, NASDAQ 25, and the RT, which is the Russell Index, is 3. So, these are trading all night, which is great. So we get an idea. And we'll talk about futures at some point, but this is futures, and they're up tonight a little bit, okay? So I'm going to let you guys go and have a good night. And if no other questions, all right, we'll see you back in the chat, and then hopefully maybe next week you guys let me know what topics you want to go on to next, and I'll go over that, which will definitely be spreads, how to buy spreads, and then we'll get into selling options. All right? Good night, everybody.